Welcome to episode 3 of the Tax Lady podcast. Tonight I'm joined by Larry Pendleton from Virginia. He is a real estate investor and a CPA. So he's going to give us a lot of valuable information on our topic today, which is retirement and taxation. And I'll let Larry introduce himself.
Thank you, Irina, for having me. Yes, Larry Pendleton, CPA based out of Virginia. My firm is called PC Financial Services, where our focus is to help real estate investors achieve financial freedom through real estate investing and tax strategies. So looking forward to today's discussion, or tonight's discussion, I should say, and adding value from here.
Great. Yeah, thanks. So Larry and I just had a really nice 10-15 minute conversation before we got on. We got to catch up. We do get to talk during the year, sometimes real estate, sometimes tax related. And I'm glad we have this opportunity to go on live, even if it's just once a year so far, to talk taxation. And this is a really good time for that because, this is tax season. I think the IRS opens up for filing on the 23rd, which is Monday. So people are getting ready for all of that. So Secure 2.0 is the legislation that was passed by Congress at the beginning of this month. And, when I read into it, there weren't really that many changes, except for how much money you can put away during the year. They normally increase that. And there were a couple of things that I saw in there that were great for wealthy earners. And like I had mentioned to Larry just a couple of minutes ago, I think retirement, putting away money into retirement becomes important or kind of almost mandatory sometimes if you're building a large portfolio of assets maybe, and you're trying to maybe secure some of your capital that way for future projects or things like that. So retirement is important for W-2 employees, right? So the biggest thing around this legislation was that now when you start at a corporation and you go work corporate and you start a job, they're supposed to put you into a 401k if they have more than 5 employees, and you can opt out. But the goal is to get more people to sign up for retirement, to do 401ks and to do Roth IRAs, and even 529 plans. I had asked you about that. Are people still doing that? And you said yes, they are. And so I think it's really important that people don't stop doing that. It's a good way to secure some money for the future. And with 529 plans, now that you can roll them over into a Roth IRA, you can make your college student beneficiary of the 529 plan, and use that money for a real estate project or opening up a business, or to your discretion, however you'd like to use that money. And Larry, so if I did that, let's say if I rolled over money into a Roth IRA, I'm self-employed. Let's say I had a 529 and I rolled it over into a Roth IRA, and I decided that I want to go and put this money into a project like buying a multifamily unit, or I don't know, a commercial property or whatever. What is the taxation on that? Do you get some sort of valuable kind of tax mitigation if you did it that way?
Great question, and thanks again. So the main thing about when it comes to retirement accounts is really like the type of retirement account. So yes, you can now take the 529 plan and convert it into a Roth. Also keep in mind that it has to be in place for at least 15 years. So it just can't be something recently created and then moved over from there. But you just can't create just any type of retirement account. You really want to make sure you're doing Roth accounts, or not Roth, but self-directing Roth accounts. And the reason why self-directing, because that is what is allowed to actually go out and invest in kind of tangible assets like real estate from that example there. And then depending on how it's all structured, you can mitigate your tax hit because you're passively investing into multifamily. Now, if you're getting into more flip deals, you want to be more cautious because you have certain tax implications that hit a little bit harder if you're running active businesses out of your Roth accounts. So it's all about this kind of working with your tax advisor, working with your custodian and your financial advisor to kind of know, okay, if we move these funds over, what type of retirement account we need to create, and then what type of assets we can invest into from there.
Okay, great. Yeah. It always comes down to a particular situation, right? So every family is different. You know, whenever you put money away into retirement or savings, you might be doing it, you know, different depending on, you know, how old your kids are, if you're doing a 529 plan, or again, if you're a W-2 employee or you've been self-employed for a year or the last 20 years, right? Because those 1099s add up after 20 years versus if you just done a year of 1099, right? So that becomes an interesting way to put money away into retirement. Okay, so, you know, what I'm also seeing is that with retirement age going up, and they do this when they put into retirement information, they talk about the age of when, if you keep the money in an account longer than 69 or whatever the age is, like now it's 73 or 75, that you can compound more money into your 401 or your IRA if you're a little bit older or over the retirement age. So, you know, is that something important to mention, or, you know, is it better to just take the money out when you're hit the retirement age, whatever it is, to avoid the big tax bill, and take the money and use it? Or, you know, we talked about taking money out before retirement age, but now if it's at retirement age or keeping it longer.
Yeah, so part of that, and that's one of the, because most of these changes with the Secure 2.0 really don't go in effect until 2024. This one with the increase in the required minimum distributions, that actually goes active this year. Whereas before at 69, if you had an IRA account, you were required to take out distributions. The government then tax you on the income if it's a traditional type of retirement account there. So that's them just trying to kind of, hey, we got the tax benefits years ago, it's been sitting, and now they want to start making up the taxes from that standpoint there. The increase from 69 to 72 becomes rather beneficial, to your point of people can accumulate more returns, more retirement savings within their retirement accounts for extended period of time. And it's also a good tax strategy timing as well of, okay, could you now take pieces of some of your retirement account and then convert it into a Roth so that you're not getting hit with a larger tax bill, like at the end when you're required to make distributions. You can somewhat start to control how much you can get taxed up to that point. So it has some benefits as well for those who are kind of at that older age, and be able to kind of take advantage of this. Where it's like, hey, let's start moving some funds over. And once again, like I said, just working with a tax advisor that know what they're doing so that they can set you up and properly from there.
Right. Absolutely. So there's a lot of different tax advisors and retirement specialists out there, and you know, people who work independently as well as for large firms like banks like Northwestern Mutual and other fund managers who can even self-direct it for you. I know there's a lot of private companies out there that do that and stuff. So absolutely, very important stuff. I think. What do you think about them making it mandatory, you know, putting you into a 401k as soon as you get into an employment not really giving the option for people to really, you know, what if they wanted to do their own like IRA and not do a 401k?
Well, as you know, and this is something that we always share with our clients, is that governments, they put certain law changes in place to really get the masses to move in a certain direction. So with the heavy strain on Social Security, like they really want to push for people to kind of help to start saving for their own retirement and not so much rely on Social Security, Medicare that like may or may not be around, considering the debt ceiling and everything. So stuff like this was okay. You're now working. You're now required. You're automatically mandatory required to contribute to our IRA account. And most of these changes are kind of just pushing people to that boat and to entice employers and employees and self-employed individuals to that. So that mandatory, and there's a way of opting out of it if you don't want to invest into it, but that's what they're kind of pushing for there. So how I feel about it, like I say, is I mean, I prefer people that have a choice, and you're kind of forcing this on them. And if they don't know, and this is why this is one of the things that doesn't really get passed until, I mean, it gets passed, but don't really go into effect until 2024, because there's a lot of still information that they have, or guidance they need to provide employers and their HR departments to help explain this to people so that they know what their options are. So more information is most likely going to come out throughout the year on how this stuff is going to be fully implemented, to ensure that everyone knows what they're getting into.
Yeah, absolutely. It definitely makes a difference. And it probably changes a lot of things within a corporation, or, you know, even a 6 employee kind of business, which is considered a small business still. And part of that is, you know, the culture shock of those changes as well is very important. Very good point about HR involvement with that. Absolutely. Okay. So let's kind of switch over and talk a little bit about real estate and retirement. You know, because real estate is still one of the best vehicles to retire with, right? So if we're talking to people out there who right now are either W-2 employees or who have 401ks or maybe even a Roth IRA, and they're thinking about, you know, buying their first property or, you know, entering into the real estate market, you know, what would you tell them would be the biggest benefit of using their retirement to invest this money into real estate?
One, to know the type of investing you're going to get into. Like I said, you can get into flips, or you can get into buying holes, and like that's going to have different tax implications depending on the type of retirement account that you're investing out of. Now, if you're in traditional, your custodian may not have any real estate options, and then if you try to pull the money out, you possibly get hit with penalties, as well as being taxed on that income that you're pulling out. Now, you could try to apply for the loan from your retirement account, and then having to set up a payment plan to get that money back. But at least you'll be able to avoid taxes and penalties from just doing straight distributions, as long as you get the money paid back in a timely manner. So, like I said, that's one way to kind of look at it from there. If you have those self-directing retirement accounts, that allow you to kind of, here like checkbook retirement accounts as well, that allows you to invest in real estate. Just know that whether it's UBIT or UDFI, additional taxes associated if you're leveraging debt on the UDFI side of things to buy properties, or if you're flipping properties, or you're doing more transactional deals, land deals, build to sell aspect of it, like you will be hit with this unrelated business income tax, because that's not considered as passive income. If you're just investing in someone else's deal, that's passive, so you can start to avoid some of those these hefty taxes, and then still kind of leverage the tax benefits to help mitigate your gains within the retirement account. Only thing to be mindful of as well is that you, the individual, don't get the benefit of depreciation, losses, stuff like that if you're investing out of your retirement account. That goes back in the retirement account, so you can't use it to really offset your W-2 or your other business income from there. So a lot of moving pieces. Like I said, that's why like you can just when you can easily like YouTube try to get as much education as you can, but having the right team around you to kind of make sure you're fully aware of what's going on, so you can watch those pitfalls.
Absolutely, absolutely. If it's one thing that I learned about real estate this year is that, you know, even in real estate, you can make a ton of mistakes, and it's not always, you know, rainbows and butterflies. You know, like I've seen clients who, you know, wanted to buy their first commercial property and couldn't because, you know, of the market changes, and, you know, with interest rates, how they were changing last year, I think a lot of people kind of had a lot of roadblocks. So let's kind of change the pace a little bit. Let's talk about real estate and, you know, what direction is real estate going into? Because I think there's a lot of talk about, you know, where our debt ceiling is, first of all, in the economy, and whether or not we want to keep growing that debt ceiling. We talk about, you know, interest rates, you know, what's going to happen to interest rates, because they fell a little bit over the last couple of days, but, you know, there's still that fear that interest rates might go up. You know, I don't know how the market plays in pricing. Of course, that matters on inventory and demand, but it's interesting to see how the real estate market is still, you know, growing, and it's just still booming. And is it because I see so much action in it because I'm working in it, or is it really happening that the real estate market is still not slowing down, and should it?
And there's from an investor standpoint, I mean, there's going to like, yes, everything is like a bit saturated in different markets, especially the more popular areas, low income tax states and all that there. But and I know people like to make the comparison to '08, but one of the differences is that, like I said, we do have that low supply of housing, a lot to do with when the material costs and lumber price were up significantly in 2021, 2022, slowed down a lot of activity there. So even though interest rates are rising, I mean, most investors are kind of looking at it, okay, you still have what your return, cash on cash return that you're trying to receive. And as long as you have that a higher rate of return over the interest rate, you're still making money on the deal. It's just kind of knowing like, hey, this is a good time to do a sale, do a new deal. It's just kind of knowing like, hey, this is a good time to do a sale, do a new deal. It's just kind of knowing like, hey, this is a good time to do a sale, do a new deal. It's just kind of knowing,
Is it still doing that for you?
yeah.
That's weird. Is it still doing that for you?
Yeah, now it's repeating what you're saying.
Oh man, okay, I pressed something. Sorry, that was my bad.
Okay. So,
Okay, yeah. So let me kind of recap what you just said. I was totally listening. So it's a different ballpark for everybody, kind of, it seems like, because it depends on where you are as a real estate investor, what you're doing, you know, what kind of investor are you, and, you know, what's your participation in real estate. But it's definitely an interesting market to follow and see, you know, the changes, because houses really don't stop selling. You still see, you know, agents and brokers who talk about, you know, their closings and things like that. And, you know, people, you know, still look for financial support, right? They look for funding and they talk to lenders, and there's still a lot of interest. So there's definitely inventory out there, and there's definitely a demand. It's whether or not, you know, it could hold up. But I think, I mean, really, I see real estate as being very profitable if you are correctly strategic, right?
Mhm.
So if you're a buy and hold investor, your goal is to then hold on to these properties for as long as possible for the maximum appreciation and return on your investment, right? I see Airbnb being super popular. We had a webcast on that last time we talked about Airbnb. And that's become an interesting type of real estate investing, and a lot of people are getting into that. And of course, fix and flips. And so I think the real estate topic is always going to be an interesting topic. And the more it's out there in the media and social media, I think the more people are still going to just, care about the real estate market. Like I said, like 1 in every 3 or 4 people that you meet these days are somehow involved in real estate or have an interest in real estate, whether they're an agent or broker or an investor or doing some other work in real estate. So it's really interesting to see where all of this is going. So we talked about retirement. There's definitely benefits to putting money away into a Roth IRA and compounding that interest over the years. And also using that money, hopefully maybe to buy your first real estate if you decide to do that. And I think it probably also is important to say that this is all informational purposes. People should be talking to a tax advisor. So you and I both are tax advisors, and it depends on the situation. And after speaking to a client and understanding fully what their situation is, that's when you can determine things about what's a good strategy for them for retirement or any sort of investing or wealth management programs. So it's also important to mention that. And so we talked about retirement. I think the retirement age is going up. I think more and more people are still in the workforce, and they're retiring at a much later age than most people anticipate, or whatever their retirement age is now. But I think, people aren't retiring until their 70s now. And so, you see a lot of baby boomers who are getting into real estate at like a very late age. That's how popular the real estate market is.
Yeah, and actually, it's one of those things, and why part of it, a lot of it, why the IRS is trying to entice the public to invest more, is to sell, or to, I would say, more is save more, and using retirement accounts as that mechanism, so that they can probably get a better handle on, okay, what is the retirement age. Like, yes, we're living longer, even with COVID and all that, what happened with that. Like, so we'll see where the life expectancy ends up going. But to your point, where like people are working longer because maybe they have not like invested in assets or put money into their retirement accounts and all of that. So they're trying to entice the young younger generations to start, as well as entice all generations to kind of start putting money into it from that standpoint. But it all still kind of goes back to the individual educating themselves, like whether it's your podcast or whatever they want to YouTube or Google from that standpoint, like get that general information, but then also know that it's all just kind of in general. Like, you need to really get with experts to kind of pinpoint how this is going to affect you. And the cost of those consultations is going to be worth its weight in gold, because it's going to help you save a lot of money on the back end and save you some headache as well.
Absolutely. I think there is no age minimum of getting into real estate, and there's definitely no timeline or deadline. Like I mentioned before our call, I think, there's still some people out there who have, mastermind programs or groups, mastermind groups and millionaire groups and stuff like that, who really, really push the agenda of real estate onto people. And I think that's great. I'm a firm believer that as an investor, you make your own decision, right? Whether you invest or not. It really ultimately, as an advisor, I can see where you are financially and tell you where the market is and see if it works for you. And I can offer advice, but you as the investor make the final decision whether you make that investment or not. I don't get to decide that for you. So it's very important to note that, you know, there is no deadline or timeline for investing in real estate. There's plenty of inventory out there, and there's plenty of interesting ways of getting into real estate, and retirement packages are one of those ways.
Yeah, especially if you're looking for the capital to do so, you may have some untapped capital, and that's just going to only help grow your retirement account even more from there. So, and there's other opportunity to do it if you're looking for cash flow. But real estate is a team sport. I mean, I've been doing it for over 7 years, and like all my best deals have come with me like having a solid team around me. And like I said, I bombed in situations where, because I tried to do it all myself, thinking small and trying to keep everything, I just stay in my lane, focus on what I'm great at, and then partner with others who are great at what they do.
Absolutely. That's something that I learned in 2022, how important in real estate it is to partner with people. Because if you're doing big projects, and even, you know, buy and hold, you know, you might want to consider partnering, because it mitigates some of your tax risk exposure, and just, you know, your financial risk exposure as well, because you get to whether or not pass through the losses to your partner or not, or whatever, you know, you decide to do, however you decide to set up that JV. So yeah, partnering is definitely one of the important things and ways of getting into real estate. And who's that? Hi.
It's your bedtime, ain't it? So
Hi.
broke into my office.
What's your name?
You say Wesley?
Wesley, nice to meet you. You're a real estate mogul too? Like your dad? Yeah, for sure.
So, but yeah, like I said, all definitely all solid points. I mean, always a great discussion on just like how to, because like I said, it's all about kind of like finding like additional capital, and like whether it's working with team, like working with passive investors who have the capital, or tapping into your own retirement accounts, especially if it's difficult to get financing on your own from there. So yeah, so it's really important to kind of just know where your strong suits are when it comes to how to invest in real estate, and where the capital and who's going to manage the deal and all of that, and go from there.
Definitely, absolutely. And as your partnership grows in real estate, I think it becomes even more important to have an advisory board, right? You got to have the legal team, you got to have the accounting team, you have to have the project managers and the contractors and whoever else on your team. And so it's important that I mention that both Larry and I are practicing tax advisors. Larry is in Virginia. If you have any questions, of course, to always reach out to us. Larry is on Facebook, and he's pretty open about people contacting him on Facebook, right?
Yep. You can reach me on Facebook. You can reach me on Instagram, LinkedIn. I'm pretty sure I really have my link to my page in the show notes. And yeah, happy to connect with others, see where I can add value, and go from there.
Awesome. Yeah, well, thank you so much for joining, Wesley and Larry. Thank you so much. We talked about a bunch of fun stuff, and I hope to see you again.
Thank you. Have a good one. Appreciate it.
You too. Bye-bye.